The Wealth Advocates simplify the financial world and show you how today's events could affect your financial health so you feel confident about your financial future.
Welcome, everyone. We're very excited to have Robert Spendlove with us today. We have had him back several times, and every time has been really valuable information and insight. I'm going to actually read his bio because I don't want to miss. This is a great background. Robert is the senior economist for Zions Bank. In his capacity, he monitors and reports on economic indicators and public policy developments for the bank. Founded in 1873, Zions Bank is Utah's oldest financial institution, and it operates locations in communities throughout the Intermountain West. Robert's research interests are primarily in the areas of macroeconomics, demographics, financial markets, and public policy. He frequently advises and briefs policymakers as well as business and civic groups throughout the United States. He's also regularly called on to give expert analysis in the media through print, radio, and television. He is also known for his insightful and understandable approach to explaining economic trends. Robert also serves in the Utah House of Representatives, where he was elected in 2014. He represents District 42 in the legislature covering parts of Sandy, Cottonwood Heights cities. He is the vice chair of the Executive Appropriations Committee. He also serves on the Revenue and Taxation Committee, the Public Education Appropriations Committee, and the Health and Human Services Committee. That keeps you busy. Robert serves on a number of boards and commissions, including the Utah Economic Council, the Utah International Relations and Trade Commission, and Envision Utah. His previous experience includes time as the governor's deputy chief of staff for federal relations, the governor's chief economist, and state demographer. Boy, I'm struggling with that one. Demographer. Robert received a Master's of Public Administration with an emphasis in economic public policy at the University of Utah. And most importantly, Robert is married and is the father of 4 children and 2 grandchildren.
Thanks to John and Patrick for having me here. It's always an honor to come up here and speak to you. So we've done this a few times, and it's still kind of a period of uncertainty in the economy. That's one of the lasting effects that we're having from the economy. And so you'll see a number of different distortions that we're seeing in the economy right now throughout the nation, throughout the world, and in our region as well. So if we jump into it, one of the big themes right now is if we look at polling, people don't feel like the economy is doing well. This is a poll put out by the Wall Street Journal recently, where 63% of voters feel like the economy is not doing well, and 74% of persuadable voters don't feel like the economy is doing well. So why is that? So that's what I want to dig into a little bit. This is kind of our number of the day. We have a number of different measures of inflation. This one is the personal consumption expenditure. Just came out recently. And what it shows is that we've had inflation that's a lot higher than it is today, but it's still too high. We need it to be lower than it is. And I'm going to get into this a little bit more in just a minute, but that's kind of what's driving a lot of these perceptions of the economy right now. The other thing that people are really struggling with, I like to say people are grumpy. And so why are people grumpy? They're grumpy because interest rates are high. As recently as 2021, mortgage rates were around 3%, 2 to 3 to 4%. Now they're at 7%. And that is a big adjustment to go from a very low rate environment to a rate environment that is a lot higher. And it's kind of sticking around that 7%. So that's kind of the short-term look at mortgage rates. What about long-term? So this is looking at mortgage rates all the way back to the 1960s. And you really start to see this trend where if you look at that long-term average, we're not even to that average yet. We're still below that long-term average. And even if you take out the high and the low outliers, we're still right around that very long-term average. But if you think about distortions, for the last 40 years, really since the mid 1980s, we've been trained to expect rates to come down in the longer term. And so the assumption with buying a house was you can refinance later and have your rate go down, or you can buy that house, fix it up, and flip it and get another one. We're not in that environment anymore. And it's really tough for people to adjust to this new environment. So they keep saying, when are rates going to come back down again? And it's probably not going to happen. And that's a tough adjustment for people to come to. What's the effect of that? The gray line is existing mortgages. The black line is new mortgages. So this is for the last 20 years, showing that if you refinanced or got a new home, you'd have a lower payment. It's now the opposite, where if you buy a new home that's equivalent to your existing, or if you refinance, you're going to be paying more. And that is making people grumpy. So why is that all happening? Well, the Federal Reserve has been dramatically increasing rates for the last 2 years. But if you go back a little bit further and think about distortions in the economy, the first distortion really started with the Great Recession of 2008 and 2009, where the recession was so bad that the Fed pushed the Fed funds rate, this is the shortest term interest rate, pushed it all the way down to zero, and they left it at zero, essentially very low rates for a generation, from 2010 really until 2022. And so that retrained us to expect rates to be lower. But then in the last 2 years, they've done the exact opposite, and they've gone from 0 to over 5%. And so that's essentially the Fed going from slamming on the gas to slamming on the brakes of the economy, and it's causing these really tough distortions in consumers. The other thing the Fed has been doing, this is the Fed's balance sheet. It's essentially the Fed's bank account. And it's a tool that the Fed hadn't used before the Great Recession, but now they've been using it aggressively. And the big one in the last few years is the Fed's balance sheet went from around $4 trillion in 2018 to by 2022, it was at $9 trillion. So they flooded the market, flooded the economy with $5 trillion and increased their balance sheet. And so that's what fueled a lot of the growth in the economy. Well, look over the last 2 years, the Fed's been shrinking its balance sheet. They've gone from $9 trillion to about $7.4 trillion. So they've been pulling a lot of cash off the back out of the economy and pushing it back into the sidelines. And so that is causing kind of this, what they would expect would be an economic contraction, or at least an economic slowdown. So the next question is, what is the Fed going to do? Now, we've looked at what the Fed has done, but the question is now, what is the Fed going to do? So the Fed is going to be meeting in the near future. We're going to be getting a new forecast, but this is their most current forecast. The bottom line here is the Fed has said they are going to drop rates. However, it's data dependent, and the Fed is going to keep rates higher for longer. So by the end of this year, they said they're going to cut 2 or 3 times. I think we're probably going to have to pull that back. I don't think they're going to be able to cut rates 3 times. At this point, I think it's more like 1 or 2 times. And so our rate, so we might be 50 basis points or 0.5% lower a year from now than we are right now. But if you look out in the longer term, they're not going back to zero again. Even after several years, they see themselves kind of ending out at around 2.5% in the very short-term interest rates. And then the big question is this having the impact that they want it to have? They're trying to slow the economy. And they said they would be data dependent. So what's the data look like? Well, if you look at gross domestic product, that's our broadest measure of the economy. We are seeing some signs that GDP is starting to slow. We just got new data on GDP for the first quarter, came in at 1.3%. So we have seen it slowing for the last 3 quarters. And what's interesting about this, we get a number of revisions to our GDP. And the latest revision said that consumers are starting to pull back a little bit on their spending, which is what the Fed wants to see. But if we move to the labor market, before the pandemic, a good number was 150,000. For the past 2 years, we've been growing at about 250,000. So the labor market has been overheating for 2 years. We're finally starting to see some cool down in the labor market. Came in at 175,000 for April. The unemployment rate, again, we want to be kind of in that sweet spot of unemployment of around 4.5% to 5%. We've been below 4% for several years now. And so it is starting to very slowly move up, but we're still in a range that would define labor shortages. The other thing, this is probably my number one indicator of a recession. You can see how the unemployment rate moves up very quickly when we go into a recession. We're not seeing that yet. But over the next few months, if we see that unemployment rate move from 3.9 up to 4.5 or 5%, that would be a sign that the economy is cooling too much. And then we might be going into a recession. But at least right now, this is a good indicator that the economy is still doing okay. Our labor force participation, so going into the pandemic, it was 63.3%. We're still not even back to where we were pre-pandemic. So we've still got millions of people sitting on the sidelines. One of the things that we saw, there's a long-term trend of that drop in the labor force participation rate. That's retirement of the baby boomers. And it's not an unexpected trend. We've been anticipating this, but what happened with the pandemic was it pulled that trend forward and kind of pushed those older workers into retirement, and we're still kind of adjusting to that as well. So the result of this tight labor market is we've seen wage growth much higher than our long-term average, where our average is about 3%. Even now, with the some signs of a slowdown, we're still seeing wage growth coming in at about just under 4%. So to get back to normal, we need that wage growth to be back down to 4% again. And the reason we care about wage growth, it's great if you're a worker and you're getting big pay increases. But if you're a business owner and you're trying to make payroll and you have limited margins, you have to come up with that money somehow. And the only way to do that is to raise prices, so that if wages are too high, wage growth is too high, it can drive inflation. So back to inflation, we are seeing that inflation slowing. Back in 22, it was around 9%. It's slowed down to the mid 3% range, which is good. But again, it has to be back to 2%. The Fed has a stated target of inflation being at 2%. And you can see that before 2020, for 20 years, it was at 2%. So this is where the Fed is really struggling. They're saying, yeah, the inflation's down, but it's sticky. And so we need we need clear signs that it's back at that 2% path. And it looks like that inflation is kind of stalling out at the 3 to 4% range. And this is why people are grumpy. You've got economists telling everyone the inflation is down, but this is what consumers are looking at. They're saying, I don't care what the inflation looks like. My prices are up 20%. And it's really hard to adjust to an environment where prices are up 20% over the last 4 years. Everyone, again, wants those prices to go back down. They're not going to go back down. And again, that's this tough adjustment of saying, okay, how do we deal with prices that are much higher than they were just in recent history? So if we break down the inflation into its components a little bit, core inflation is dropping as well. However, so remember, our target is 2%. Core inflation is actually higher than headline inflation, coming in at 3.6% for the US. Our region is doing a little bit better, coming in at around 2.8%. What is driving that inflation? This is another area where there's been a lot of soul searching, let's put it that way, among economists. You had a lot of experts saying, well, housing is going to go away as a problem, and that's not happening, at least till now. Housing and services are driving the majority of the inflationary pressures right now. goods prices have at least leveled, but it's that housing and services that are driving that inflation. And you can see that when you drill into the housing inflation, even higher than, not only higher than the headline, but higher than the core, coming in at 4.5% for the US, 3.6% for our region. And then what about services? Again, even higher. US service inflation, 5.3%. And for our region, it's 4.3%. So if we break it down, this is economists just trying to figure out what's going on under the hood. We have this measure called supercore inflation. So we strip out food and fuel and housing, and we're essentially just left with services minus housing. Once we do that, we get, again, inflation above that target, above the headline, coming in at 4.9% for the US, 4.4% for our region. And one of the things I'm a little nervous about is our region has been accelerating for the past few months. The bottom line message of all this is inflation is better than it was a few years ago, but we're not out of the woods yet. And then healthcare is one of those kind of emerging possibilities. I've been talking to a lot of people in the healthcare sector, and we may start seeing healthcare inflation accelerating in the next few months. So the big question, when do we get back to normal? Well, if you think about all that extra cash that was infused into the economy, a lot of that cash is still flowing around. I estimate there's probably another of that, total $5 to $7 trillion that was injected into the economy. There's still another about $1 trillion flowing around, and it'll take months for that to kind of work its way through the economy. But that argument, there's kind of a debate going on within the economic community. One side says the inflation is over, we're back to normal, and this chart would agree with that. This is looking at inflation over the last 25 years. However, I'll show you the one that Jerome Powell is worried about. This is a different 25-year period. This is 1960 to 1985, where we didn't just have one cycle of inflation. We had successive cycles of inflation getting worse over time. And Jerome Powell is doing everything he can to try to prevent the mistakes that we had in the 1970s, where we declared victory too soon, didn't actually have the inflation under control, and then it reheated. But some of the effects we're seeing, though, especially to lower income and middle income families, is they are getting tapped out. So if you look at the savings rate before the pandemic was 6.4%, it's now 3.6%. So people are having to tap into their savings to keep up with their spending. Another one of the mounting issue that is facing our country, national debt. By itself, this is looking at national debt relative to GDP. It's not only the highest that it's ever been in a non-war period, it's projected by the Congressional Budget Office to increase even more over the next few decades. But by itself, that's not too much of a problem. It's the servicing of the national debt that really causes problems, where just recently, the net interest cost of servicing the national debt is now higher than the budget for national defense, for Medicare, and for Medicaid. So it becomes less possible for us to do what we want to do if we're spending spending a large amount of our federal budget on just servicing that existing debt. Another one of the big issues that's going to be facing us soon, Social Security. We're now 9 years away from Social Security becoming insolvent. So that is going to happen in 2033. So if you think about the things that Congress needs to be dealing with, they need to be dealing with the national debt. They need to be dealing with Social Security very soon. And then when we look at some of the risks, specifically commercial real estate. So we saw big risk in hotel and hospitality. That's coming down and getting better. But the office space is that default rate on office space is something that's kind of looming and facing the economy right now as well. What about our region? And this is one of the really interesting things. The Utah economy is continues to be one of the best in the country. Wall Street Journal says Utah has the hottest job market. U.S. News says that Utah is the best state in the country. So we've got all these accolades about how great the Utah economy is, but when you talk to consumers, they have a similar feeling to what we're seeing nationally. This is the Gardner Institute of the University of Utah just found that for the last 2 months, consumers in Utah feel worse about the Utah economy than nationally, which is really surprising and is a little bit concerning as well. And the reason for that, it comes down to housing. So this is the ratio of home prices to household income should be about 3-to-1. And right now it's over 5-to-1. So what that's showing is that housing is unaffordable, and it's something that people are really struggling with in the state of Utah. It's also now, historically, it's always been cheaper to buy than to rent until just recently. It is now cheaper to rent than to buy in Utah, and by a pretty dramatic amount. So if you think about the societal impacts that this can have if we continue to have this imbalance, the next generation is really struggling to get into home ownership and to be able to build wealth using real estate and home ownership. The result of this, or one of the results that we're seeing, so this is looking at the percent of homeowners that have a mortgage with at 4% or lower. Utah is the highest in the country at about 72%. Lowest is West Virginia, under 50%. Now, this is great if you have a home. But what this means is that 72% of homeowners are going to be very reluctant to move because they've got such great rates. And so how do you get new homeowners, younger people, lower income into home ownership if people that have existing homes aren't willing to move? And we're not building enough homes. So this is a trend that started after the Great Recession of builders dropping back on their building. And so this is the gap between home building and household formation, peaked out at 56,000 shortage. Then we started to improve that, but now we're going back in the wrong direction again as the lending market is difficult and builders are pulling back on their building activity. We need to build 153,000 units just in Utah just to meet our demand. And so that's a daunting task that a lot of people are thinking about. So looking at population, we do continue to see not as dramatically as early on in the pandemic, but people are continuing to move out of coastal areas and into the Intermountain West, moving to Utah, Idaho, Texas, Florida, and the South. Within our state, the big growth that we see, Utah County coming in 22,000 new people, this is total population growth. 22,000 people added to Utah County. That's 3.1%. In Cache County, a little bit slower, about 1,400 new people being added to the population for about 1%. State rate of about 1.6%. But we also see that donut effect of relatively slower growth in the urban core and a little bit higher growth in the periphery areas. In employment, we continue to be doing really well. The national rate of employment growth, 1.8%, Utah coming in at 2.1%. So we're not the top in the country, but we're one of the best employment growth in the country. This is a heat map. So looking at employment growth by county, and you can really see how Utah kind of jumps out. Southern Idaho, northern Arizona doing really well. Also the South seeing strong employment growth, a little bit slower in the Midwest. And then within our state, again, we're comparing to the state rate of 2.1%. Cache County coming in a little bit below that, about 1.2%. But then we see like Morgan, Summit, Wasatch counties coming in above that, and then also the southwestern portion of the state seeing employment growth a little bit above the state average. But this is just a good indicator. So there are several states that haven't even recovered the jobs lost in the pandemic. Utah is back on that strong employment growth trend. So that's a really good sign of the strength of our economy. Sectors, we see strong growth in construction, healthcare, government. Healthcare and government, you have to be a little careful. We're seeing these are the impacts of the recovery from the recession 4 years ago, where healthcare and government have been lagging in their recovery. So they're kind of catching up to the other sectors of the economy. But you see that in terms of actual jobs added, they add up to about 24,000 of the 36,000 total. With the unemployment rate, again, the national rate is around just under 4%. Utah is just under 3%, one of the lowest in the country. Looking at that heat map again, you see very high unemployment in the coastal areas, especially California, Oregon, Washington, and kind of the East Coast, but much lower unemployment in the Midwest, and again in Utah, northern Arizona, southern Idaho. Within our state, Cache County continues to have one of the lowest unemployment rates in the state, coming in at 2.2%. Morgan is the lowest at 2%, and then our highest is kind of the southern part of Utah, Garfield County, coming in at 9.4%. Labor force participation, kind of going back to that, this is one of the shining examples of the strength of the Utah economy. While the nation hasn't recovered that labor participation, Utah is above the pre-pandemic level as we very effectively pull people off the sidelines and back into the labor market. So kind of putting it all together, the big question is the Fed actually going to cut rates? And if so, when? And it all depends on whether that inflation can come back to where it was, can return back to that 2% level. Will the labor market continue to slow? We are seeing positive signs on inflation and on the labor market, but we need more data. We need more time for that to happen. Kind of our large risks, international uncertainty, especially wars with Israel and Gaza, Russia and Ukraine, saber rattling with China and Taiwan, all creates more uncertainty. And then domestically, the election season is already adding volatility. The uncertainty about what will happen with election year this year is adding to that volatility. But the bottom line, though, is there is uncertainty, there is risk, there is volatility, but the U.S. economy continues to be performing stronger than any other economy in the world. And within the U.S., our region is the strongest, and our state continues to be one of the strongest. So I am bullish on the Utah economy and on the U.S. economy.
Thank you for listening to The Wealth Advocates. Join us every month by subscribing on Apple Podcasts, Spotify, or Google Podcasts. You can also look for The Wealth Advocates on Stitcher and YouTube. Want more information about today's topics? Reach out to John or Patrick directly by visiting wealth-advocates.com.